Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a mixed day on Wall Street Monday. Investors appearing to be unmoved by trade news of an agreement between the EU and the United States. At the end of the session, the S&P 500, the NASDAQ ended the day up, the Dow closing lower. Tariffs may be toying with kids' entertainment. We're taking a deep dive into the toll that duties may be having on playtime. And small investors may be coming up big when it comes to the housing market. We'll explain how and who may be winning and losing in real estate. Well, as affordability issues and elevated rates keep individual home buyers on the sidelines, the share of investor purchases of homes is hitting a high. That's according to analytics firm Cotality. Here with a closer look at the real estate purchasing landscape, we have Kinlock Partners co-founder and CEO Bruce McNeilage. Bruce, it is good to see you. So there was this good piece in the Journal, Bruce, which I know you saw, and I know you saw it, Bruce, because you were cited in it. And it was talking about this trend, Bruce, which was fascinating, of investors swooping in here, Bruce, and buying these single family properties. And the piece notes that so far this year, investors who buy homes to flip or rent have made up 30% actually of purchases of both existing and newly built single family homes, Bruce. I wanted to just start there at a full stop, Bruce. When we talk about these investors moving in, what kind of investors are we talking about, Bruce? Are we talking about are these smaller investors? Are these private equity players? Who are they?
Sure, they're all the above, right? They're small mom and pop investors that are buying 4 and 5 houses here and there. They're mid-tier companies like us. We'd like to do another 100 to 200 houses by the end of the year. They're larger players, and then they're the ones in between, family offices, sovereign wealth funds, the hedge funds, the REITs. Everybody is coming into the market right now. There's been too much money on the sidelines, and we're really starting to see these builders benefit because they have a lot of excess inventory, and folks like us can come in, clean up their inventory here in the next few months, and really help them with their profits and buy up their inventory.
So that's interesting, Bruce. So part of the trend here is it's home builders have a lot of inventory. That's part of the driver here?
Yeah, absolutely. Mom and pops are having a tough time qualifying for mortgages, right? The interest rates are just too high. In the last 52 weeks, you look at Freddie Mac's numbers, they've basically stayed the same. We're hovering just under 7%. People cannot afford mortgages right now. So the next best thing is to rent a brand new house. Well, who do you rent a brand new house from? The people that have bought one or the people that have built one. And so we're really offering something that most people can't get, a brand new house. Instead of buying it, you're renting it.
And the smaller investor, Bruce, in particular, this was really the trend the kind of Journal pointed out here. Is there a reason right now, Bruce, that smaller investors would be more active?
Yeah, sure. So small investors can borrow money from credit unions. They can borrow against their 401k. They can do a lot of different things that larger investors aren't going to do. And when you see the price of houses coming down, when you see the inventory going up, and when you also see all these builder incentives, it really helps a small investor get in the game, so to speak, because they are getting these discounts from these builders.
And is the business model there, Bruce, for the smaller investor, it's what, you move in, buy a home, make some modest renovations, rent it with the aim of one day selling it? Is that the idea?
Yeah, most people are looking at either buying a new house or what I call a used house and fixing it up. You cash flow it for a number of years, let's say 3 to 5 years. It goes up in value, and then you sell it. A lot of people are just in this for the capital gains. Some people are in it for the income and capital gains. But the name of the game is to have positive cash flow from day one and then sell it at a profit at the end.
Are there advantages, Bruce, a smaller investor relatively would have over a private equity player?
Yeah, I think they can be nimble. I don't think they have the same rules. They certainly don't have investment committees. And so they can choose to buy a house, rent a house, sell a house, and they can pay what they want to pay. Again, they don't have a mandate from an investment committee. So if they want to buy something with a lower cap rate, if they want to buy something with a higher cap rate, or something big, small, older, newer, they can be as nimble as they want, where the larger funds can't. They have mandates, they have a buy box, and they've got some restrictions, and we do too.
I'm sure, Bruce, there are some folks who are watching this right now who think, well, hold on a second. Doesn't this theme that Bruce and Josh are talking about ultimately make it that much tougher for regular Americans, Bruce, to come in and bid and compete?
Yeah, so you would think that, but what we're doing is we're not taking inventory out of the market. For us, we're building brand new houses, not taking inventory out of the market. And then these houses are available in the MLS. You buy houses from the different large builders. Anybody can buy those houses today. It's just people are not. So investors are coming in, cleaning up this inventory, buying the houses. But quite frankly, they're available to everyone. It's just people can't afford them. So it's buying up the houses and making more stock available, again, not to buy, but for people that can't buy, but to rent.
And for viewers, Bruce, describe a little bit about Kinloch Partners, your firm, because you've been in this business for a long time. A little bit about your history and what you're seeing in the market right now.
Yeah, so I'm in the business 20 years. We started Kinloch Partners about 15 years ago. We're throughout Tennessee, Georgia, and through South Carolina. We're a mid-tier player, about 250 houses a year. And what we're doing is brand new houses, a little bit different than most. We do 4 and 5 bedroom houses. Our houses are larger, have high-end finishes, and we make those available to folks at roughly $1 a foot, which is really unheard of in our industry. You can rent a 2,500 square foot house, Josh, for $2,500. I mean, the payment on that to own it's probably $3,500. And for the first time in all 50 states in our country, 50 cities, the largest cities, you can now rent a house much cheaper than you can buy a house. And so Kinloch Partners takes advantage of that, and we offer high quality houses to people that can't afford to purchase them, and we offer them long-term rental opportunities.
Bruce, always great to see you and to have you on the show. Thanks as always for your time. Stick around, much more Ask for a Trend still to come. As the toy industry awaits a crucial trade deal between the U.S. and China, CEO of toy maker Basic Fun joined Market Catalyst to discuss how the business is navigating tariffs. Take a listen.
We stand a lot better than we were at 145% on Liberation Day, but 30% is, no real consolation. I remember when it was first announced at 10, we were all losing our minds and we knew that 10 was a lot. Today, I guess we'd probably be pretty happy at 10. We're also in our industry hoping maybe for an exemption for toys, given how special this category is and how difficult it is to manufacture here in the States. But we're doing our best. I mean, manufacturers in toys and other import segments and categories kind of been eating it a bit, passing a bit of it along to the retailers, and the retailers have been passing it a bit along to the consumer. You're not seeing it a lot now. But as we get into the late third quarter and fourth quarter, you will start to see it more. And certainly as we get into 2026, the tariffs will become a cost of doing business and a built-in cost in the product. So it's going to be a trickle effect of increased prices to the consumer and lower profits to manufacturers. It's, in some ways, somewhat of a transfer of wealth.
We're showing the Care Bear video, and I'm feeling very nostalgic, Jay. So of that 30%, how much for you guys do you anticipate getting passed on?
So I would say of the 30, about 20 is going to get passed on. And the question is, will the retailers absorb some or all of it, or will it get passed along to the consumer? Again, this year's a little tricky because everybody's not been sure of where it's going to end up. So a lot more has been absorbed so far than will in the future. So I would anticipate probably 10 being absorbed by the importer, 10 being absorbed by the retailer, and 10 being passed along this year. But the fact is, as we get into 2026 and brand new items become created, those items will be designed, marketed, and sold with the tariffs built in. So there will be a reckoning. We can already see it with automobiles. It's very hard to absorb 15 or 25% tariffs plus on steel and aluminum and not be infected and all the things that are coming back across the borders between Mexico and the U.S. You're going to start to see it in cars probably more than anywhere else soon, but you'll see it in consumer products very quickly. Nobody has the kind of margins to absorb 30%. We're hoping it it gets a little bit lower as these trade negotiations go on the next few days and weeks,
right,
with China in particular.
And Jay, talk to me now about the demand side, right? What have you guys been seeing there? Because there's been a lot of concern this year, especially that lower income consumers were not, that their spending power was waning a little bit. Are you seeing that in your business yet?
For sure. I mean, we are seeing a strain on the lower income consumers. Some of them aren't shopping because there are a lot of low-end consumers that shop in value stores that are immigrants, and they're worried about going out and shopping and sort of being seen. We're seeing some tension on their spending and wallets. People are holding back. But in toys tends to be somewhat of a recession-proof category where people are going to spend on their kids. I will say there'll be a bit of a shortage on the shelves for a period of time because we didn't ship for about 6-8 weeks. And there's a lag. The inventory that came in the first part of the year is selling down and selling through. Probably see a lot of empty spaces and slots on shelves right now. The retailers are struggling to really understand the tariffs and how to work the pricing, but also struggling to reinstate orders for the rest of the season. So it's going to be a really funky year this year. As always, we would suggest the toys you think your kids really want and they tell you they really want, you should get sooner than later. It's going to be a very strange Christmas season this year.
Yeah, one of the other things I was reading that you and some of your peers in the industry are doing is sort of maybe shipping stuff without batteries, for example, trying to look for some creative solutions, I guess, to bring down cost. What other things are you guys looking at?
Yeah, we call it sort of deconstructing or the deconstruction option. So we'll create a toy. It could be a Tonka truck with lights and sound in a beautiful display box. And we'll offer it to our customers several different ways. One way might be without the battery so the consumer can purchase the batteries themselves. One might be with a sort of more simplified package or no package. And these are things that sort of take some value out of the toy, but they help to keep the price at a more reasonable level. But in the end, it still is somewhat of a tax or cost to consumers, because if you don't get the battery in the toy, and I can buy the batteries cheaper than a consumer can at retail, you might spend $5, $6, $7 to buy the batteries to put in a toy instead of having them included in a package. Try to wrap a teddy bear or a Tonka truck that doesn't have a package. It's kind of funky and it'll be, a bit of a strange shape. So sometimes that package is also part of the whole joy and presentation of the product when a child gets it as a birthday present or a Christmas gift. But we're offering the options to our partners to deconstruct a little bit, take some value out, which would sort of mitigate a little bit of the cost of the tariffs. The one advantage that the consumer has over the manufacturer is the consumer has an unlimited amount of choices, whether it's in cars, price points in cars, features in cars, whether it's in toys. You could buy a $10 plush, a $20 plush, a $30 plush, the same thing with a car or a truck. Manufacturers have limited lines. We can't just change our lines overnight and make things overnight. So we're kind of stuck with selling what we've created months, if not years ago, tooling, designs. The consumer has a lot of options. If they want to spend less or get less value, they can exercise their choice, whether it's online or in the stores.
The S&P 500 and the NASDAQ eke out records to kick off what is going to be a jam-packed week for Wall Street. Here with the trading day takeaways, we've got Yahoo Finance's Jared Blikre. Jared.
Thank you, Josh. Eke out is right. The S&P 500 just barely closed in the green. It was enough for a record. NASDAQ a little bit higher. And it was all thanks to the semiconductors led by the kahuna, the biggest stock in the solar system, NVIDIA. Let me get a quick market cap check. $4.31 trillion. And look at Broadcom, 1.384. That's nothing to sneeze at either. But here we go. So the semiconductors really outperforming today. AMD up 4.32%. Let me just show you the sector action real quickly, because another theme I was noticing was we don't have great breadth in the market right now. We had energy, that was on the back of crude oil. We might have time for that later. Tech and consumer discretionary, that's an Amazon and Tesla story, mainly Tesla today. Everything else in the red. Another thing I noticed that was interesting was the S&P equal weighted index. So the S&P 500 equal weighted, that was down 0.5%, and that's just a continuation of the low or poor breadth theme, because every stock gets the same weight in there, as opposed to the S&P 500, which just barely crossed into the green by the close. But thanks to those mega cap names, that finished in the green. So all in all, without NVIDIA, this would not have been a positive market today.
What would you say was the big mover in today's trade?
Let me get to that right here. And for that, we got to go to some of those trade headlines that we saw over the weekend, and that was causing the US dollar to surge. And I also want to add that the seasonals are turning bullish. And so we saw that EU and US deal kind of take shape, and we got a big decline in the euro. And so conversely, we saw the dollar shoot up there. When the dollar shoots up, sometimes that spills over into equities. And so it's not surprising that materials, you saw XLB take the biggest hit. That's where you see gold miners, and we'll get to that in a second. But first, on the dollar, I also did a segment this morning on seasonality of the dollar, which is just turning very bullish this within these few days here, according to one of my models. So I have 3 lines here. White is what has happened with the dollar this year so far in 2025, and it's basically been just a slow and steady line down. So 2025 has not been friendly to the dollar. However, I have 2 models. Blue is going back to 1971. It's an average of all the years. It's not very volatile. It's hard to see here, but it does inflect up a little bit in this time of the year. But what you really notice here is a steeper line. That's the green line. If you go back to 1971 and you only include the years where you have the same day of the week, like Monday, July 28th, you want to make sure you have that exact configuration, then we get a lot more steep action here. And that model has served me well over the last few years since basically I discovered it. So on that, I am saying that there's a warning that the dollar turns up here strongly. That is a non-consensus position. We know that there's been a lot of bearish sentiment, a lot of bearish positioning in the dollar. And so this is kind of a risk factor that I think exists in the market. And let me just show you real quickly what happened today on the back of this US dollar index strength, this broad strength in the dollar. And I'll go to the futures for that. There's more green than red here, but we really saw the metals take a hit. So copper was down almost 3%. Gold took a little bit of a tumble. Silver also in the red. But look at cryptocurrencies. Crypto was really the red factor today.
So metals down. What about other commodities, Jared?
All right, so here we got to touch on crude oil here. And crude oil was one of the biggest gainers of the day. So I'll go back to my futures chart here, and there we go. Crude oil is going to be second or third actually next to cocoa and palladium. I had a chance to sit down with Dan Dicker today of the Energy Word. We talked about trading futures, and this is for Stocks in Translation. Episode drops tomorrow. Let's take a listen.
Oil definitely does not belong in anyone's portfolio. I did it I traded on the floor for 21 years, and I still trade oil futures today. But I am a trained professional. Do not try this at home. These are the kinds of markets where if you do want to have an investment in oil, and obviously I shepherd other investors who want to be engaged in the energy markets, so there is an oil part of that, you find stocks that have a relatively good compliance with the oil price. Oil companies, I tend to put people into infrastructure. It's a lot easier for them to understand and leverage on the basis of an oil price. So there are ways to invest in oil prices without actually getting involved in the futures.
Yeah, and so what I like about that, don't trade the futures unless you are not the faint of heart. He likes energy stocks in general, but he also was a big proponent of clean energy, and I got a heat map for that here too. More of a mixed board today, but these have really taken off over the last month. There's a lot of headwinds with regulatory issues, Trump blocking the IRA, but in general, futures are kind of a dangerous thing to trade. Stocks not.
Thank you, Jared.
You
Appreciate
bet.
it, my friend. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.